Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of speaking with Brendan Hall. Brendan is with Hall CPA, and he is the certified CPA and a national speaker and founder of Real Estate CPA. Their company does a lot of webinars and speaking engagements around, tax benefits of real estate. And we are here to kind of learn more about it. Brendan and his company themselves invest as well through passively and also have many investors who invest along them. Brendan has a previous career background from PricewaterhouseCoopers and Ernst Young, and after that he launched his own company. So welcome to the show, Brendan. I appreciate you spending time.
Thank you so much for having me. I appreciate you inviting me on.
Awesome. Give us a quick background, Brendan, as to how you got started and kind of shifted towards, the CPA practice and also the real estate side of things.
Yeah. So I started in, the journey kind of started in 2013. I was working at PricewaterhouseCoopers and was in their consulting practice, and I wasn't really enjoying it. So I started looking for a way out. I found real estate, as most people do. How do you get out of your corporate job and boom, invest in real estate, get the cash flow? And that was the original goal. Through that, I found Bigger Pockets. So I was doing some research and stumbled across Bigger Pockets, which is this big online forum for real estate investors. And I started asking questions, but then started answering tax questions. So people were asking a lot of tax questions, and I had a lot of fun answering as many questions as I possibly could, especially since I viewed my PwC job as very boring, and this was providing me a little bit of an outlet. So
Sure.
That's kind of how I got into real estate to begin with. And then the CPA firm just sort of spawned on that. I mean, I was just answering tons of questions all the time, and people eventually started asking if I was taking on clients, and I eventually said yes, and the rest is history.
Nice. How does your firm look like today? Like, how many clients and, office employees and all that good stuff?
So we have a team of 15, and we are currently in the process of adding 3 more. So we'll soon be 18.
Wow.
We have a little over 500 clients across the United States. They are all over the place, West Coast, East Coast. We are a 100% remote CPA firm. So we don't have an office. People don't mail us documentation, and we do everything on Zoom, everything on audio, everything on video. And my staff is virtual too. So I have a completely remote team, and they live all over the country. So that's what we look like today. But every client is in real estate, every single one. In some capacity. We work with some really small landlords, and we also work with like 10-figure funds. So really large shops as well, and we'll typically provide the entire suite of financial services at that point. And most of my team invests in real estate too. So collectively, between the 15 of us, we have 300 units.
Nice.
And I think it's a cool differentiator when we're talking about CPA firms.
Nice to see a blend of someone who has in-depth experience as to what happens on the ground, and also kind of see the tax benefits that come with it as well. So for our passive listeners, Brendan, give us some background about what are the different sort of investor types you see, and what sort of different benefits and limitations that you see when it comes to taxes in general.
Yeah, good question. So you typically have people that are actively involved in real estate, and then you have people that are passively involved in real estate. And the folks that are actively involved in real estate will usually yield better tax results than those that are just passively involved in real estate. So if I had like a W-2 job and I went and put $100,000 into a real estate syndicate, My cash flow stream from the syndicate will be tax sheltered, but I'm not going to get any additional tax benefits from that investment. Whereas if I'm investing in real estate actively and more than my any other activity that I have going on, so that's my main gig is investing in real estate, and then I go invest in a real estate syndicate. Well, now not only is that income stream tax advantageous, but whatever loss passes back to me from that investment, I can usually claim against all of my other income. So there's a lot of rules around passive activity, and the active investors in real estate will usually come out ahead.
I see. What are the limitations for passive folks in terms of, how much they can sort of depreciate or how much they can write off and things like that?
Sure. So section 469 of the tax code, this is where all the passive activity rules are defined. So section 469 says, in summary, by default, all rental activities are passive. And passive losses can only offset passive income or gain on sale from another passive activity. So if I have two rentals, rental A generates income, rental B generates a loss. They're both passive by default per section 469. And rental B's loss can offset rental A's income. If I sell rental A at a gain, rental B's loss can still offset rental A's gain. So, but it's still all passive. So that's what section 469 says. Every rental activity is passive. There are two exceptions to the rule. The first exception is if you earn less than $100,000, you can take a passive activity loss allowance up to $25,000 a year. Now, you only get the $25,000 if you're actually earning less than $100,000, but it's going to be phased out. That $25,000 loss allowance will be phased out as your income increases above 100,000 and approaches 150. Once it hits 150, the $25,000 loss allowance is gone. So it's completely phased out. So that's exception number one to the passive activity rules. The exception number two to the passive activity rules is qualifying as a real estate professional for tax purposes. And that's the apex of tax planning. That's what everybody wants to hit, right? The real estate professional status. It's a lot harder to hit than most people will tell you. And it is actually relatively black and white. A lot of people think that it's very gray and it's not very well defined. And that's not true once you read all the tax court cases on the topic. But the point is that is an exception to the rule. So section 469 says all rentals are passive. Passive losses can only offset passive income unless you earn less than 150K. That's exception number one. Or you qualify as a real estate professional. That's exception number two. Now, why would we care about an exception? We care about the exception because if we qualify for one of these exceptions, we can take our rental losses and we can offset our other income streams, because what we're doing is we're reclassifying them. We're pulling them out of that passive activity bucket. And we're putting them into the non-passive bucket. And now I can have a rental that generates a $10,000 loss, and I can offset my W-2 income or my spouse's W-2 income with that loss. So it becomes much more powerful if I can qualify for one of the exceptions.
Wow, that's awesome, man. So basically you're saying from, if I were to maybe categorize at a high level, so you got the passive, the active, and then I guess on top, the apex, as you said, is the professional status, wherein you can pretty much write off and come right through your earned income, and technically can also pay no tax, basically.
Yeah. So the active piece was my way of sort of talking about material participation, which we don't have to like dive into, but in reality, you have either a passive activity or you have a non-passive activity, and rentals are always passive.
I see.
The two exceptions, again, earn less than $150,000 or qualify as a real estate professional. If you qualify as a real estate professional, there is a second hurdle, which we can dive into, but you have to qualify as a real estate professional. You have to materially participate in the rental activities, and then you have a non-passive rental activity.
Sure. Now, somebody like me, Brendan, who has literally 200 properties, manages this on a full-time basis. I mean, we own our own property management and construction company and stuff like that. So we qualify that as sort of in the professional bucket for years now. What are those exceptions that you're talking about? What is that hurdle you said?
Well, so the real estate professional rule that is an exception to the passive activity loss limitations described in section 469 of the tax code. So what that means is if you qualify for an exception, in your case, your 200 units, if those generate losses, you can use those losses against all of your other income that you earn. If you didn't qualify for the exception, then those 200 units that generate losses, you're not going to be able to use those losses to offset your property management income, or if you have a spouse with W-2, you can't offset that income either. But because you qualify as a real estate professional for tax purposes, because you materially participate in your rental real estate activities, your combined rental real estate activities, then the losses are non-passive. So you can go and run cost segregation studies on your properties. You can find ways to generate larger losses, current year losses, that you can then use to offset all of your other income, your business income, your W-2 income, gain on sale of stock, whatever other income you have, you can offset it with your rental losses.
Awesome. Thank you so much for clarifying that. Now, Brendan, a lot of times, like high income earner professionals are looking for some tax shelter. Their main motivation is to, how can I reduce taxes and things like that, right? What are some of the strategies you can suggest that they can do to perhaps, reduce their tax burden?
Sure. So the first one is to just invest in real estate. If you invest in real estate, if I buy a rental property, I can earn $10,000 in cash flow, but I can tell the IRS that I actually lost $2,000 because of a little component called depreciation, which is a non-cash expense that I get to claim every single year as a benefit of owning the property, right? So in this example, if I cash flow 10,000, and if we're just keeping it super simple, and I have depreciation of 12,000, then I can tell the IRS I actually lost $2,000, but $10,000 hit my pocket. So I do have the $10,000.
Sure.
I'm just telling the IRS that I lost two. And that's just the way that we can shelter rental real estate income streams via depreciation. So to answer your question, strategy number one is simply just buy real estate. Because if I can do that 10 times, now I have $100,000 in cash flow. But I'm telling the IRS that I lost 20. And even if I can't use the loss, that's still beneficial for me because I'm not paying tax on the $100,000. I've completely sheltered it.
Right.
And this is Warren Buffett's approach to investing, right? Warren Buffett pays millions and millions and millions in taxes every year.
Right.
But compared to his total income, it's very low. And that's why everybody says, oh, Warren Buffett pays less taxes than his secretary. No, he doesn't pay less taxes than his secretary. But the taxes he pays compared to his total income is less than his secretary's ratio. So if I have a $200,000 W-2 job and I pay $50,000 in tax on that, that's a 25% effective tax rate. Or sorry, $50,000 tax on the 200. That's a 25% effective tax rate.
Right.
But if I add a $100,000 cash flow stream that I'm not paying tax on by investing in real estate, now I've earned $300,000, but I'm only paying $50,000 in taxes on my original W-2 income. Right. So now whatever that turns out to be, maybe like 18% or something, my effective tax rate has been reduced from 25 to 18 or 19%. So first strategy is just invest in real estate. If you want immediate tax benefits though, strategy number two is to buy short-term rentals.
Interesting.
Yep. A short-term rental is a rental activity that is the average tenant stay is less than 7 days or it's less than 30 and you provide substantial services. I'm not going to focus on less than 30 and substantial services though, because most investors don't provide substantial services to their guests. So we're going to focus on less than 7 days. The way that you figure this out is you look at all of the rental days that somebody was occupying the property, and then you divide it by the number of tenants that stayed in the property. So if I have 70 rental days and 10 tenants that have stayed, then my average stay is 7 days.
You average it out, basically, you're saying.
Average it out. Yep. Relatively simple. Now, the reason that this is a unique piece of the code is because short-term rentals are excluded from the definition of a rental activity under section 469 of the code. Now remember, if we rewind this podcast back 15 minutes, we were just talking about section 469. And remember, section 469 says all rentals are passive. To get around the passive activity rules, you have to earn less than $150,000 or you have to qualify as a real estate professional and materially participate in your rental real estate activities.
Mm-hmm.
Well, if a short-term rental is not included in the definition of rental activity per Section 469, then that means that a short-term rental falls outside of the scope of
Right.
Section 469,
Mm-hmm.
meaning that you don't have to qualify as a real estate professional in order to claim your losses. You just have to materially participate in the rental real estate activity, and it's a much lower bar. It's also something that people with full-time jobs can qualify for. People with full-time jobs can't qualify for real estate professional status because to be a real estate professional, you have to spend 750 hours in a real property trade or business and more than half your time. So if you have a full-time job and you spend 2,000 hours in your full-time job, you have to spend an additional 2,001 hours in real estate, and that will never fly if you're audited in tax court, right?
Right.
So you have a short-term rental. Now you don't have to qualify as a real estate professional. You just have to materially participate. A short-term rental does not go on Schedule C. It stays on Schedule E, and that is not up for interpretation. That's how it works. It only goes on Schedule C if you're providing substantial services to your guests. Otherwise, it's on Schedule E. It's a short-term rental. It falls outside of Section 469, meaning that you can, if you want to, you can cost segregate it, and you can take the losses as non-passive as long as you materially participate.
I see. And that in turn, you're alluding to that all those losses, you can write it out against your earned income as well. Would that be a correct statement, Brendan?
Absolutely.
I see. Got it. Now, Brendan, what about, let's say if high income earners are, earning, right? And then can they do anything from entity structuring, like maybe set up an LLC and perhaps do something to the extent that they can classify themselves as entrepreneurs and open some like solo 401k accounts and things like that? Can that be used as a hedge that you can maybe perhaps invest a lot more dollars into your 401k, something of that nature?
Good question, and the answer is no. So setting up an LLC, setting up a business is generally 99 times out of 100 not going to help you from a tax perspective. So I can set up an LLC and I still get to claim all the same expenses that I could claim if I didn't have an LLC. All I'm looking for with expenses is, was this a business expense? And I do not need any sort of LLC structure in place in order to do that. When we're talking about rental real estate, an LLC is not going to help you from a tax perspective. So you can put property into an LLC or you can own it personally, and your tax situation is not going to change.
Right. LLC, as they say, is passed through directly, basically.
Exactly. Yep. It all passes through. So there's no real change in your tax position. If you were to set up an S corporation or a C corporation, now we're changing the tax position, but we wouldn't want to go that route with rental activities. We might go that route with a management company, something along those lines. Now, your question about the solo 401k, if you don't need to set up a company to run a solo 401k, you just have to generate business income, self-employment income. So I can go and offer, tax services on a 1099 basis, and that 1099 income can be contributed to a solo 401k. Or I could go and set up an LLC like Hall CPA PLLC, and I could offer services through that company, and I can set up a solo 401k through Hall CPA. But the key is that I have to be generating self-employment income.
And I guess it's assumed you're saying that income generated off of that has to be then invested back into, if you're let's say putting a solo 401k. So you cannot really take your your normal income and invest it. Would that be correct statement?
So you can't take your W-2 income and put it into a solo 401k. No, you cannot do that.
Right. Okay. Sounds good. Now, staying on the passive investors' mind, Brendan, sometimes passive investors kind of do not wrap their head around some of the tax benefits that come with it. And I'm more referring to, let's say, passive investors are investing in various syndicates, and you see a paper loss, a K1 statement at the end of the year. Can you maybe explain how that works, and just kind of give us some numbers in terms of, let's say, if I invest $50,000 or $100,000 in a syndicate, obviously you're getting cash flow and things like that. But at the year end, how does that sort of K1 help you or shows a negative number? Can you maybe delve into that?
Sure. So the simple answer is that in most cases, if I'm investing in a syndication and I've got a negative number coming back as that rental real estate income box on my K1, in most cases, it's actually not going to help me currently.
Mm-hmm.
But it doesn't mean that it doesn't help me at some later point. So let's explain this. So if I invest $100,000 into a real estate syndicate, let's assume that I'm investing into a multifamily syndicate, since those are the hot syndicates these days.
Sure. Mm-hmm.
So I invest $100K into a multifamily syndication. And in the multifamily syndicate, they run a cost segregation study. And a cost segregation study, what they're doing is they're basically saying, okay, we bought this property and we're going to depreciate it over 27 and a half years. But we know that not all the components within the property will actually last 27 and a half years. So let's run a cost segregation study to segregate the value of the acquisition between different depreciation buckets, so different life buckets, so that we can get a more accurate representation of when the components within this property are actually going to die, essentially. The cost segregation study takes the acquisition price and it cuts it up between a 5, 7, 15, and 27 and a half year depreciation life buckets. So you end up with these 4 buckets. Now, with the 2017 Tax Cuts and Jobs Act, we now have 100% bonus depreciation.
Right.
100% bonus depreciation allows us to immediately expense via depreciation any component with a useful life of less than 20 years. So if we go back to that cost seg study, we're taking value out of the 27 and a half bucket and we're putting it into 5, 7, and 15 year buckets. And then we look at bonus depreciation and we realize, we can 100% expense all that because it's less than 20 years.
Wow.
So
that should be a large percentage at that point, right?
Typically about 25 to 30% of the acquisition price. Yes.
Wow.
Yep. So if I buy $1 million property and I run a cost segregation study, I can typically bonus depreciate $250,000 to $300,000 in the first year.
Wow.
So if I'm an investor in these deals, let's say I invest $100,000, my allocable loss, because that bonus depreciation is going to create a loss,
sure,
for the entity, not an operating loss, but a tax loss. And if I'm an investor in that deal, I'm going to get allocated a large portion of that loss. And if I put $100,000 in, my allocable loss might be $92,000.
Right.
So I get the K1 and it says that I lost $92,000. And it doesn't mean that I actually lost $92,000. It just means from a tax perspective, I get to tell the IRS that I lost $92,000. So what can you do about that? Well, most limited partner investors can't do much with it unless they have other passive income. Right now we go back to Section 469 and we look at Section 469 and it says every rental activity is by default a passive activity. So this $92,000 loss that I have is passive, and passive losses can only offset passive income or gain on sale from another passive activity. So I get this $92,000 loss and I look across my portfolio and I ask, do I have passive income? Or do I have a gain on sale from a passive activity? And if I do, I might be able to use that loss. If I don't, and if I don't qualify as a real estate professional, right? So we're assuming that I work full time, my spouse works full time, I don't qualify as a real estate professional, I can't use the loss. It's just a big fat $92,000. I might get a little upset, or I might realize, this is going to be suspended and it's going to be carried forward indefinitely until I can generate passive income, or I have gain on sale that this loss can offset, or until this activity is disposed of. So when this syndicate liquidates in 5 years, maybe my allocable gain is, or my total allocable cash or gain is $150,000. Well, if I have this $92,000 loss that's been hanging out, sitting on my books for 5 years, I can now offset my gain with that loss. So it will benefit me at some point, or I will at least claw it back. But most limited partners, what they run into is they have to suspend that loss until they can use it at some later point.
I see. Now, staying on that topic, Brendan, is this something then that passive, that loss or that $92,000 in our example, does that get divided on a prorated basis to all the passive investors, and their portion gets sort of written up on K1, and that's how those K1s get distributed to all the passive investors. Is that kind of how it works?
Yeah, so I guess I should have been more clear. That I was talking about if I had invested $100,000, then my K1, my personal K1 is going to show a $92,000 loss. So the 92,000 is coming out after that allocation has already been made.
I see.
So to get to that point, I might buy a $1 million building between three partners.
Right.
I might run a cost segregation study that creates a $300,000 loss. And then my allocable share of that 300K is
92,000. Right,
Mm-hmm.
right. That's pretty powerful. So in effect, we are talking about, if we kind of just step back, is you invest $100,000, you're getting the cash flow on a monthly or quarterly basis, depending on whatever the syndicate is. But once the cost study is done, you're potentially getting a large sum that's in negative number that's allocated to you. So on one hand, you have the positive cash flow, but on the other hand, you're getting to write off that income by using the negative number on your K1. So that's pretty powerful actually at that point.
Yeah, absolutely. And in future years, you might be repositioning that multifamily asset, right? So the multifamily asset might be producing net income for the entity, and I might be allocated net income as a result of that in future years. But if I have a $92,000 loss that's been suspended, then the future net income coming from this entity or really any other passive entity, I can offset that $92,000 loss with. So I get $92,000 in income tax free over the next, however long it takes to use that loss.
Right. Awesome. And now, Brandon, speaking of this bonus depreciation, right? Is this going to stay for a long time? Is it a permanent feature, or is that something that's going to be phased out? How does that work?
Good question. So it is not permanent. It will begin to be phased out starting in 2022, and it's going to be phased out over a period of time unless Congress extends it.
I see. Got it. Now, let's talk about 1031 exchange, Brandon. And in simple terms, it's your ability to basically defer your taxes and, kind of leapfrog into bigger and better investments. Can you maybe perhaps dumb it down and kind of share the benefits of it for passive investors, Brandon?
Sure. So a 1031 exchange comes from Section 1031 of the Internal Revenue Code, and that's where the name comes from. And you've got it exactly right. It's just I bought a property for $100,000. It's now worth $170,000, and I have two choices. I can sell it today, and I can recognize a $70,000 gain, or I can engage in a tax deferral strategy, one of which is a Section 1031 exchange. So I can sell the property and then roll it into, say, a $200,000 property. So I sell it for $170,000, I roll it into a $200,000 property, and I don't have to pay the tax today on that $70,000 spread from the sale. Right. So I'm just basically deferring the recognition of my gain. And 1031s are quite powerful. I can 1031 forever, and then I can die, and then I can pass that remaining asset down to my children, and they get a stepped up basis in the asset. So I could 1031 for 5 decades. So I start with a $100,000 property, and I could end up with a $5 million property. But if I sold the $5 million property, I'd have a really big gain, right? It's been built up over 5 decades. Now it's $5 million. And if I sold that, it'd be an astronomical gain and an astronomical tax. But if I die and I pass it to my heirs, they get a stepped up basis equal to the fair market value of the property as of the date of my death. So if it's worth $5 million, then their basis increases to $5 million, meaning that they can sell it for $5 million. And since their basis is also $5 million, their gain is zero. Right. So 1031 exchanges are a great way to actually, one, just defer recognition of tax on any sort of built-in appreciation, but also a really great way to, it's good to integrate with estate planning, and it's a good way to just start generational wealth.
That's awesome. Now, speaking of that 1031, Brendan, how about, like, let's say in your example where we started, let's say from 100,000, and you went on multiplying and climbing up the ladder, and eventually you had a, let's say, a fictitious property you sold at 5 million, right? And you, let's say, went through property 1 through 10 before you were disposing of the 5 million property, right? Now, a bit of an intricate question comes in is that, let's say you were going from property 1, 2, 3, 4, 5, 6, 7, 8, and so on, right? And what if you were doing improvements to the property? Like, for example, let's say you buy you started with 100,000, but as you went along in your chain of properties, let's say you bought a property for, let's take another hypothetical example. At, let's say, property number 4, you were at 1 million, for example. But then for that 1 million purchase of the property, let's say you are again adding another, let's say, 300,000 in different improvements that you would have done. How does that sort of work with the basis? Like, does that mean that 1 million plus 300,000 you would have invested, does that basis get stepped up to that number? Can you maybe kind of clarify some of that?
Yeah, absolutely. So let's keep it really simple. Let's say that you started with $100,000. That was your basis. That was the fair market value. And then over time, you never added another dollar to the property. And let's just also say that you never depreciated the property, which is not allowed, by the way. So take this example with a grain of salt. But for the purposes of simplifying the numbers,
Sure.
you never depreciated the property. So we get to this $1 million property. We've deferred our gain all along the way. Our basis is still 100K because we've never added another cent. We've never depreciated the property, which is, again, not correct. But
sure.
We then add $300,000 of improvements to the property. So now we're all in for $1.3 million. The basis is going to be my original basis of 100K plus the improvements of 300K. So now my basis is 400K. So I've got a $1.3 million building with a basis of $400,000.
Right. So your basis is, I should correct myself. You're right. Absolutely right there. That your basis is would be whatever is your gain is kind of, you're considering that as a basis, basically.
Well, no. So for tax purposes, the basis is the cost to you, and the built-in gain is what we're deferring, right? So we're rolling that over. So the built-in gain will not become my basis. And this is where it kind of gets confusing. It's like, well, wait a second. I put $1 million. I own $1 million property, so I put $1 million into it, which is true, but you haven't paid tax on 900K of that, so it doesn't get to be counted as basis. Your after tax income or your after tax cash that you ever put into this deal, that was your original $100,000. So that's your basis.
Right.
And if you add an additional 300K via improvements, now your basis is 400K.
Right. So your gain plus whatever investment you practically did becomes your stepped up basis, I should clarify.
Oh, well, so if you are passing away and giving it to your heirs, then your basis will be stepped up to whatever the fair market value of the property is. So let's say that you...
Right. In that example, you're correct. If you pass away, whatever is the eventual at that point. But in our example, let's say you're at property number 4 and you invested, in our example, 300K. Your original gain of 100 plus $300 that, 300,000 you would have invested in improvements, they get added up and combined. So is that true?
Yeah. So your basis will be combined. Your original basis plus any additional improvements you've made, that will increase your basis. But most of the time, it's also going to increase your market value. So it's not going to reduce your gain, if that makes sense.
Right. It makes sense.
Yeah.
Good.
Unless you make really bad improvements, non-value add improvements.
Right. Makes sense. Now, speaking of different property types within the 1031 exchange, Brendan, can I maybe go from, let's say, a single family house to a multifamily and perhaps go into, let's say, a self-storage or some industrial property? How does that work?
You can go from real estate to real estate as long as there's investment intent. Yes. What you cannot do is you cannot exchange paper for real estate. So sometimes we run into folks that are invested in syndications. They own a stake in an LLC, which is a partnership, and they think that they can exchange or defer the gain coming out of that. And that is not true unless you run some pretty exotic strategies. So when you are invested in an LLC, you own paper. You don't actually own the underlying asset. And because you don't own the underlying asset, you cannot exchange your stake for real estate. You would be exchanging paper for real estate at that point, which is not allowed. But you can go land to single family homes, multifamily homes, commercial. You can go back to land. You can exchange real estate for real estate.
I see. Good, good. Thank you.
Mm-hmm.
Now, Brendan, speaking of, like, let's say for the active real estate owners and things like that, what are some of the steps for like bookkeeping or record keeping that you can recommend so that, we kind of stay compliant with, any of the IRS audits or any questions that come along? Can you maybe give us some best practices for bookkeeping and record keeping?
Yeah, well, I highly recommend that everybody use some form of an online cloud-based software, whether it's Google Sheets. Google Sheets is nice because you can put it on your phone.
Sure.
Or it's QuickBooks Online, or even youneedabudget.com. Like, that's a great software. If you're like a passive investor and you're investing in these syndications, youneedabudget.com could be a really good answer for you. You don't really need an accounting software. You only really need like QuickBooks Online if you are buying your own rentals, or if you are the syndicator, like the deal sponsor in the syndicate, and you're trying to keep all the accounting records and do the investor reporting. That's when you need something like QuickBooks Online. But just get something cloud-based. And the key to success with record keeping is to just make it as simple as possible for yourself. I mean, you just need to create a system where you can scan a receipt in, upload it to a folder, and then be done with it. And for everybody, it's a little bit different, but the key is always using some sort of cloud-based system. If you don't use a cloud-based system, you run the risk of getting audited. I mean, you don't run the risk of getting audited because you're not using a cloud-based system, but if you get audited,
sure,
5 years later, you're going to be looking for paper receipts that may not exist anymore. So you really need to kind of categorize it and put it in an archive somewhere in the cloud.
Makes sense. Now, moving on, Brendan, I know your company does a lot of webinars and educational series and things like that. Tell us more about that and how audience can learn more about it.
Yeah, so we have a ton of educational content. We have a podcast called the Real Estate CPA Podcast, where my co-host Thomas Castelli and I interview a bunch of investors, and we ask them tax and accounting questions. So that's always fun. If you're investing in a syndication, you can email us and recommend your deal sponsor to be asked all the tax and accounting questions. So it's a good way to kind of see behind the scenes there. But yeah, we have 104 or 5 episodes at this point, so been running for a while, about 30,000 listeners a month, which is really cool.
Awesome.
That's a big one. Then we have a YouTube channel that we update periodically, and we also have a 10,000 word tax guide on our website, at least on our website as of today. But it's the ultimate guide to tax planning for landlords, 10,000 words, totally free. You can also download a copy. So we've been getting a lot of people doing that. But if you're ever interested in looking at any of that, looking up any of our content, or getting in touch, just go to www.therealestatecpa.com.
Awesome. And thank you for all your advice, Brendan. I greatly appreciate it. Is there any other contact information or anything you want to give to our listeners?
TheRealEstateCPA.com is where to go. You can connect with me on LinkedIn if you'd like. I think you can just Google Brandon Hall CPA LinkedIn, and I should come right up.
Awesome. Thank you for your time. I appreciate it, Brendan. You are always a wealth of knowledge. I personally listen to your podcast as well. So it is a source of knowledge. And thank you for your time today. I appreciate you coming on.
Thanks for having me. I appreciate it.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.